Good morning. Coming up next on the Short Vol Show Live, I want to talk to you about the term structure, how the VIX has come in a lot, but how the term structure kind of reflects that. So the case for the short and the long side in the VIX, and then I want to talk to you about a new idea I have for GameStop. That's coming up next and more on the Short Vol Show Live. Stay with me.
You're watching Famous Game on YouTube.
All right, over the last week or so, we've really had a big down move in the VIX, and you add that to expiration, which just occurred, and you have an interesting situation here. There is certainly a case, as always, for being long or short volatility, but I want to kind of discuss with you how the VIX term structure kind of balances out things. And the term structure, people ask a lot about what does it mean. We know it's not really predictive, but people ask a lot of times, you know, what you see in it. And a lot of times what I tell people, and it continues to be the case, is to understand and to get meaning out of the VIX term structure, you want to watch it over a period of time. You want to see how it changes day to day. When we just look at it, a snapshot of it, like we can do right now, it doesn't give us the full picture because you don't see how it changes from day to day. Now, obviously, the most noticeable change in the last couple of days in the term structure is simply that the front month fell off. You can see here when we look at the term structure that there is the most noticeable thing I see when I look at it right now is that there is a big spread between the cash price of the VIX, or the VIX price, which is 20.05 here, and the front month future, 23.35. That's 3 points between the futures and spot. That's a lot of distance. Now, why is it that there's so much space between the futures and the VIX? Well, if you think of it as the VIX has been going down and down, and yes, I know the VIX is up a little bit today. We're up 81 cents. But in the grand scheme of things, VIX has come in a whole lot, right, in the last couple sessions. If we pull up a chart of the VIX here, that will demonstrate that it has come in quite a bit. So here's VIX, and here's the last, let's do the last 10 days. All right, so the VIX has come in a lot in the last 10 days. There was a high of 31.9. Now we're down to, there was a low of 18.95. We're back up to 20, but it's come in a ton, right? Now, the one of the unique aspects of the VIX term structure compared with, say, the S&P futures term structure is that there is no direct arbitrage between the futures and the spot price, right? If there was direct arbitrage, then what people would do is they'd sell this future for $23, and then they'd buy the spot price paying $20, and they'd be able to make money in the spread, and these two prices would converge. However, with the VIX, since the futures are allowed to flow freely, and there's no direct arbitrage, these futures just can move around freely. The only requirement is that they do converge with spot price on expiration. But, you know, as we highlight each of these futures, they have different expiration dates. This one says expires in 33 days. This one says expires in 61 days, et cetera, et cetera. And thus, how are these priced? They're priced with supply and demand, and there are people who make markets in the futures. Now, if to think of the market, a great way when you're trading to kind of start to understand things is to think of things through other people's perspective, right? There's so many market participants out there. It's important to think of things through other people's eyes. Now, if you were a futures trader and you saw the fact that the VIX had come in so much over the last few days, it seems like, well, it could easily bounce back up, right? So nobody who's making markets in futures really wants to sell a whole lot of futures down here when the price is so comparatively low. And this is why, with this big down move in the VIX over the last few sessions, the futures prices stay elevated because the market is kind of correcting for the fact that stuff has come in so hard, and thus the futures stay higher. Now, the thing with this game of having a wide spread between the futures price and the spot price is it's a game that you can only play for so long because, as we just talked about, these futures have to converge with spot on expiration. So yes, there can be a wide spread here, but if the VIX stays low, this spread will come in. All right, so what are the implications of all this to trading VXX and UVXY and whatnot? Well, UVXY and VXX are based almost entirely on this April future right now. So it doesn't matter what the VIX price is for UVXY and VXX. The only thing it's based on is this future, right? And so, yes, the futures prices have come down, but they haven't come down as much as the VIX. However, over time, if the VIX stays down here, these will continue to fall. And you will see the front month future there's more of a pull for the front month future towards spot than there is from the second month future, and so because of that, you will see this front month future get pulled farther down than the second month, and thus contango will continue to build as long as the VIX stays down here. The other thing with this wide spread between the futures and spot is if we do get a pop in the VIX, this space here acts kind of like a shock absorber, right? So you could have the VIX pop up a point and without the futures moving, i.e. without UVXY or VXX moving very much. So when we have a VIX term structure like this, UVXY and VXX are not going to be very responsive to a pop in volatility, right? They're going to underperform to the upside if we get a pop. And A and B, there is a lot of potential here for these to move lower, right? Because this future could easily fall a point towards spot and still there being a very wide spread here. So what does this mean? Well, this means that when we're looking at a VXX or a UVXY, when you see it, oh, it's down here, you have to try to get out of that stock, that technical analysis stock mindset, because if this was a stock, you'd say, oh, well, it's come down so much, this is a great buying opportunity here. But when we look at the term structure, we see, oh, well, there's potential for this to fall a lot further. So A and B, if the VIX does pop up, these are going to underperform to the upside. So even though UVXY and VXX are down a lot, there is still a lot more potential to the downside, and the setup of the term structure favors the downside right now, even though these are at lows. So it's kind of like the VIX term structure. It kind of offsets the propensity to be long these things. So yes, you would want to be long something if the volatility is at a low, but that's offset by the way the term structure is right now, because these are going to underperform to the upside. So you could see the term structure almost as a sort of balancing effect on the odds of betting on the VIX, right? So right now, you would think if there wasn't a term structure and you could just actually buy the VIX, then it would be an obvious buy to buy the VIX right now, right? But because there is a term structure and we can only trade this through futures, the space that's created in the term structure kind of balances things out and makes it not such an obvious buy here. In fact, it makes it more of a tough call. And it seems to always kind of work that way. The markets kind of average things out between the case for the buy side and the sell side, and we can see that certainly in the term structure here today. Christina, I just transferred UVXY to Webull as I couldn't do covered calls in Robinhood. Maybe you could show how to sell those. 1,000 stocks down 60%. Buy GME at the close and sell at the open. That's the best strategy. Well, let's take a look at that for a second. KS. You know, what happens with these strategies of like buy on the close, sell on the open, or vice versa is it works for a couple days, and then everybody sees the trend, and then it reverses. So if we can look back over the last couple sessions, and we could see here, if you bought it on the close and sold on the open, you would have made money. Here, if you bought on the close and sold on the open, you would have made money. Here, if you bought on the close and sold on the open, you would have made money. This next day, you would have lost money. Here, you would have made money. Here, you would have broken even. Here, you would have lost a lot of money. And here, you would have made money. So usually, when you find a trend like that, like I said, it will be that way for a couple days and then it will shift. So if the last 3 sessions, it's been a good deal to buy in the close and sell in the open, then maybe the next one, it'll switch around. Because as soon as people recognize a trend, then too many people jump in on that trend and it kind of reverses, it seems like. Christina, when it says, you could show how to sell those in the next episode, covered calls. So covered calls is more of a strategy when you think something is going to go up to sort of help finance your trade or lower your cost, your average buy price. I want to talk, Winston May, UVXY should never be a long-term holder. Definitely agree with that, yes. I generally say to people, UVXY, if you're going to buy it, don't hold on to it more than 48 hours at a time, because you have all this decay going against you, and it's not, I mean, just look, if you question whether it's a good long-term hold, just look at a chart of UVXY, and pretty much any time period, it slowly moves lower, right? And just because it's $6 right now doesn't mean that it's somehow going to be worth $100. The only way it's going to be worth $100 is after it reverse splits. All right, so I want to go on to real quickly, because I don't want to make this too long today. I want to go on to trade idea that I have in GameStop, and this is thinking about ways to take advantage of the fact that volatility is so high and collect some decay. Now, we know with options trading that if you have 2 options that's the same strike price, the one that expires sooner is going to decay faster than the one that expires at a later date. So if we buy an option that's farther out in time and sell the exact same strike against it, and if a stock goes to that strike or stays near that strike, the option that you sold, which is going to expire sooner, will decay faster, and thus you'll collect decay every day. So an idea with GME that I had was to buy a put option a few weeks out. So in this case, I picked the April 160 put. And we'll model this in the Analyze tab and see what it looks like. So my idea was to buy the 9 April expiration 160 put and sell the March 26 expiration 155 put. And so what this is a bet that GME will go down over time. However, it's a bet where we collect money. And right now, GME is around 215, and this is the 160 and the 155 put. So they're a little ways away from here. And the time period we're talking about is one option is going to expire in 8 days, and the other is going to expire in 22 days. And it's an interesting trade because Well, there's a couple aspects about it, but the first aspect of it is just to do a one lot costs quite a bit of money. So if we look at this trade, what I'm going to do is I'm going to highlight both of these options, and I'm going to right click, and I'm going to say create. I'll just do create closing order, but we're not actually going to close it. This will just bring this order into the display. Okay, so here is, if we were to put this trade on right now, buying the 9 April 160 put and selling the 26 March 155 put, it costs $16, so $1,600 for each time you were to do this trade. So let's say, just for sake of argument, what I'm going to do is I'm going to right click, and I'm going to go to Analyze Trade. So we're going to be in our Analyze tab here, and I'm going to X out every other trade that's in the Analyze tab, and I'm going to get out of the way here. So let's say we were to put this trade on 10 times, right? So 10 times would cost us $16,000, just for the sake of argument here. All right, if I go up to price slices here, we can look at what our deltas are. What our Greeks are. So if we were to put this on 10 times, our delta would be short 9. So that means each dollar that GameStop moves up, we lose $9, and each point that GameStop goes down $1, we make $9. However, we would be collecting $763 a day. So we're collecting decay here, right? And you might say, "Wow, that sounds pretty good. You don't have that much directional risk, and you're collecting all this money every day. You know, what's the catch?" Anytime you find a trade and it sounds like, "Wow, someone's just giving me money," you know, you have to ask yourself, why am I so lucky? You'll hear people a lot of times in the forums and stuff come up with these trade ideas and say, "Oh, it's free money. This is easy. This is great." Nothing is really free money out there. There's always a catch. So what's the catch to this trade? Well, if we look at these Greeks here, okay, so just to go through the Greeks, if you're not familiar with them, delta is going to be, there's basically 3 definitions for delta, but the most simple one is just the one I just described, which is basically like equivalent shares of stock. So if we put this trade on, it's the equivalent of being short 9 shares of GameStop, right? So if GameStop goes up $1, we lose $9. If GameStop goes down $1, we make $9. Okay. However, you can see that at different prices, the delta starts to change, right? So if we move over to our next Greek here, this is gamma. This is the curvature of our position. So each dollar that GameStop moves down, our delta is going to decrease by 0.37, right? So a third of a dollar. So down $3, we lose 1 delta, right? Theta here is how much money our position costs us, or how much money we have to pay per day. So positive theta means we're collecting money every day from the position. Why does this have a positive theta? Well, once again, the option that we sold is decaying faster than the option that we bought. However, this number here, Vega, is the kind of the catch with this position, right? Long 55 Vega is how much we make or lose for a 1-point change in volatility. Now, when we've got a stock or a stock that's trading at a very high volatility level like this one here, if we look on the right side of the page here, we can see the different price levels volatility wise for options. So these numbers right here are showing per month what the average volatility is, and we can see out in April it's 340 volatility, right? So if we were to put this trade on, 55 Vega means if this just moves 1 point, if it goes up 1 point, we make $55. If it goes down 1 point, we lose $55. Now, $55 doesn't sound like much, but this could easily go down 10 points, right? And then all of a sudden, you've lost $500, right? it could easily go down 20 points and you've lost $1,000, right? It could go, this volatility could come in 100 points, right? And you could lose $5,000 just on volatility coming in. So the catch with this theta number here is this theta number is how much money you're going to make if volatility stays exactly the same here, right? Now, usually over time, if volatility stays relatively the same, you're going to collect that $700 a day, and so it seems like a good deal. However, if volatility were to come in massively, you're going to get dinged on that Vega number there. So this is a kind of position which is not completely clear whether it's going to make money or not, as are many positions, because of this Vega number here. Now, ideally, we would like to be short a little bit of Vega, right? Which would require us selling some farther out options against this position. The issue really is, however, that for us to sell naked options farther out in time, it's going to take a lot of buying power. So it's not easy for us to sell Vega far out without requiring a lot of buying power, which we don't have right now due to the fact that the account's been kind of decimated from bad trading in GME. So what I've done is I haven't done this trade 10 times. I've only done it one time, right? And so the Greeks are much more manageable here. We're short 0.93 deltas only, right? And 5 Vega, right? So if volatility goes down 10 points, we lose $50, right? But we're still collecting 76 a day. So we'll see how this trade works out. I definitely feel more comfortable now with with GME having kind of stayed high and stayed in this orbit of higher prices for a while now. I definitely feel more comfortable with the position collecting money every day as opposed to having to pay for money every day, because buying put options and looking for a down move, if it doesn't come quickly, you get eaten up as the options you own decay. So having a position on where you're actually collecting money is a much more comfortable position to be in right now. And actually that video with the billionaire yesterday talking about selling naked calls gave me the idea, well, how can I, as somebody who is not a billionaire, kind of take advantage of the fact that option prices are so high as well? And so my idea was to put this calendar spread on. So that's a trade idea you can look at. So we'll see what happens with volatility. If I was going to make a bet, if I was going to make a wager, if you held a gun to my head with this term structure here, I would say that we will see this front month future curve a little lower, and we will see contango continue to build above 8%. 8% is still a pretty healthy level. If we were to go here on our contango tab and look, now what this is going to show is what was the level of contango historically. If I isolate the last few months, we can see, wow, we've been above the red line is positive. Above the red line is contango, below the red line is backwardation. You can see we've been positive for quite some time. Now, you can see we got all the way up here, and then it shows us cruising down here. The reason why we see this big down move at the end here is due to expiration, right? As we're no longer looking at the difference between March and April futures, it just switched to now we're looking at the difference between April and May, and thus you see this pretty extreme move. It's not really an extreme move. It's just that this chart is adjusted to reflect the next relationship as we hit expiration. So every expiration you'll see pretty much, if you see a big down move like this, it's probably due to that was the expiration. So I would say right here was an expiration and right here was an expiration. And that's very common that on this curve we see right after expiration the the contango level is much lower. And as these products are based on an index that's continuous, the actual index they're based on is not going to reflect these dramatic moves. It actually smooths everything out since it's a continuous index. And so these kind of extremes that we see, these extreme changes in contango, are actually smoothed out by the indices that these products are based on. All right, well, thanks for checking out this video today. Hopefully you got something out of it. A lot of funds are still short on GME. This stock looks like Tesla. Yes, we will see Winston May once again correct. We are looking for a reverse split coming up very soon in UVXY. The announcement should come out. We're looking for it. It could come out any day right now, a reverse split. Probably see something like a 5-for-1 reverse split in UVXY. And I'm looking forward to the split because I like option prices post-split. When prices are a little bit higher, it just seems, and maybe it's just kind of an illusion, but it just seems like better trading goes on when prices are a little bit higher than $6. So I'm looking forward to the reverse split coming up. And so we'll see. All right, guys, thanks for watching today, and best of luck with your trading and whatever else you are doing this morning. And I will see you in the next one on the Short File Show Live. Have a good one.
You're watching Famous Dave.